Hi everyone, I think we'll just start. Well, thank you for attending today's session. I know it's the last one. It's been a long day for everyone who's attending all different events. But you know, as they say, to keep the best for last. So again, thank you for joining today's session. My name is Liz, I'm from SC Ventures. Just to get a gauge and maybe a little bit of exercise to wake everyone up. I know it's 5 p.m. on a Tuesday, feels like Monday. Who here is from a VC firm? Okay, CVC? Okay, wow, okay. And then startup, anyone from a startup? Okay, we have got a few startup people. All right, thank you for that. So without further ado, let me just introduce to you today's panelists. So we have Nikhilesh from Validus, we have Puiyan from Vertex, and then Alex from SC Ventures. So why don't we just kick off with a short introduction about yourself, and maybe if you have been on the other side, like for example, if you've been an investor in your previous life, maybe also just highlight that for a bit of context for the rest of the discussion. Why don't we start off with you, Nikhilesh?
I think before I start, given 90% of the audience is VC and CVC, I think there go all my jokes and jibes at the community. So I'm going to be on my best behavior. Hi, I'm Nikhilesh. I'm one of the co-founders and CEO at Validus. We are one of the largest SME lending tech companies in ASEAN, operating out of Singapore, Indonesia, Vietnam, and Thailand. Before this, I spent most of my life on the other side of the table. I used to work for a private equity fund in India. I ran the corporate M&A team for one of the largest conglomerates in Vietnam, and then ran a boutique M&A advisory firm out of Singapore.
Hi, Puiyan here. I am from Vertex Ventures Southeast Asia in India. Vertex Ventures Southeast Asia in India is actually part of a larger platform, a Vertex network, which also have presence in China, Israel, US, and everywhere. But for myself, I'm part of the Southeast Asia India Fund. We focus on early stage opportunities in the region, and we're sector agnostic. So we would do anything from consumer internet, selling tumblers and whatnot, to fintech, to agri, to deep tech and mobility. I joined the fund 4 years ago. Before that, I was with a corporate venture fund. Maybe that's why I'm asked to join this panel. I was with Singtel Innovate, which is a corporate VC for Singtel, the telco. Happy to chat more today.
Thanks, Puiyan. Hi everyone, I'm Alex from SC Ventures. So the de facto innovation arm of the Standard Chartered Bank. So a couple of things we do. We have a venture building arm. We have a fund and investments arm, which I guess Liz and myself spend most of our time on. And we also have a separate arm that spends a lot of time changing the culture of 80,000 employees, as well as the way we interact with fintechs. So before that, I was an entrepreneur. I did some time in proper financial VC. Then I did corporate venture building too, and my previous gig before this was in another CVC too. And happy to speak more later.
Okay, thank you. Okay, so the first topic of today is similarities and differences between VC and CVC. So Puiyan, why don't we start with you from a VC perspective? Like, what are the similarities that you see and also differences, and what's like the typical investment approach that you would take?
Maybe I will start by explaining a VC structure, and maybe then talk about the CVC a little bit, but maybe Alex can chime in. So VCs, I think one of the most important things to know is that we typically operate in a 10 to 12 year fund cycle, which means that we will take the first half of the fund to do most of our investing, but by the second part of the fund life, as fund managers, it's our responsibility to think about exit options and how we're going to return money to our investors, our limited partners, by the time the fund matures. So, VCs typically only have one North Star matrix, which is returns, right? And I think the difference with corporate venture funds would be, and I'm talking very broadly here because there are many, many flavors of CVCs, and we can explore more of that later. My previous corporate venture fund, where I came from, is an evergreen fund, so there's no concept of fund cycles, and we can deploy sort of as long as we like, as long as we can pay for ourselves, right? Typically, corporate investors will also evaluate and underwrite a deal with a strategic lens. So how can the corporate value add? How can the startup bring value to the mothership? For VCs, typically not so. You know, there could be impact funds, there could be sector-focused funds that look at investment from a certain lens, but ultimately returns is the North Star. Hopefully that's like the context. Alex, want to add on?
Or maybe from a CVC perspective, like do you see similarities as well?
Me? Okay.
Yeah.
Yeah. I guess maybe before we start, take even a bigger step back, right? What exactly is a CVC? I guess the definition of CVC ranges very widely depending on who you ask. I think on the most extreme end would be just a corporate that happens to invest in VCs. They do it out of balance sheet. There's no proper team doing it, and that's an extreme corporate VC. And I think from the other end, what we've seen a lot in Southeast Asia, although they are CVCs, really they're just running like a financial VC with one single LP, which happens to be a corporate. I think that there's a clear distinction between that, because I think at the further end, they operate a lot much like a VC. Good to have strategic returns, but they don't really need it. Whereas the quintessential CVC, which I think our first fund is we need to have a very strong strategic angle before we make an investment, because otherwise we are not proprietary investors, right? We are investing with the stake of getting both financial and strategic returns. So I think the main difference is there has to be a strategic, almost tick box before a CVC can invest. And I think from the startup point of view too, right? If there isn't that, it depends on what you're looking at, but I think we'll delve into that further. Sometimes that's good and sometimes that's bad.
Thank you, Alex. Nikhilesh, I know you said you will not have any of the jokes, but please do tell us a joke, during one of these questions. So you've raised several rounds of funding from both VCs and CVCs. So in your perspective, like what have you seen as like the similarities and differences? Do you agree and do you disagree? Please have some banter as well. Yeah, so why don't you answer that one? Thank you.
So to put things in perspective, we've raised more CVC money than VC money. Full disclosure, Vertex is one of our largest and first investors. But in terms of CVCs, we've got a bunch of banks and FIs. So we've got money from Cathay, which is the largest Taiwanese FI. We have Norinchukin Bank from Japan, and NH, which is the second largest banking group in Korea. But we also have very large conglomerates and families from Thailand, Vietnam, Indonesia, and Singapore. So in that sense, I have some perspective of having dealt with CVCs, both banking as well as non-banking. I think this is like a topic by itself. I do agree with the definitions, which is, yes, VCs are pure return focused, CVCs have more of, trying to find a strategic fit. But maybe as we delve deeper into it, we can share more. But the first thing to understand is, are they in for the long haul, or is this a hobby? And by what do I mean with that, right? When you're dealing with a VC, this is what they do for a living. They know the playbook, they know exactly what they want to invest in. Doesn't make sense to most of us half the time, but they at least know what they want to invest in, why, and what they want to do with the investment, right? Second biggest differentiator is this is what the team does for a living, right? Their incentives, their lives, their career is tied to it. One of the differences, and again, this doesn't apply to all CVCs, is that for some of them, they are just joining the fad. So we have had CVCs who've invested in because they thought this was a good thing to do, and then in a couple of years decided, nah, maybe investing is not for us. So what do you do with such investors? So that is part one. And the same goes for the team. Does the team understand VC investments, bring that rigor, bring the discipline, or are these, again, very experienced bankers who might be brilliant at what they do, but maybe not at investing, and would love to speak about this more as we go along.
Thank you. And then maybe going back to VC and CVC, maybe pitch yourself a little bit. We do have some startups in the crowd, but otherwise to convince the other party otherwise. So what do you think are the advantages of being a VC or CVC, and what do you think, if you can highlight, also a disadvantage of that?
No disadvantages for taking CVC money. It's all good. You're talking about
Yes.
for a startup to take our money?
Yes, exactly.
Yeah.
Why should they take your money?
Because we are very nice, but I think from a CVC point of view, obviously look out for strategics, right? And again, I mentioned, look at how they are structured and what the team is doing. I think, again, I talk about there's quite a few single LP VCs who happen to, LPs happen to be a corporate, and you can ask their portfolio companies, right, what has the corporate helped you with after? So I think you'll see in Southeast Asia, there tend to be quite a lot of those that they'll try to find a strategic value add, but it's a nice to have, because again, they are VCs disguised as CVCs because they're after one thing, right? DPI or more than one. Whereas a more proper CVC or the quintessential CVC has to look at strategic. So even if I make, let's say for our fund, it's a $100 million fund that we started with, if I make 5 times return, that's okay, decent, but if I bring no strategic value, our entire team will get dinged. Because then why did we waste 100 million investing, right? We can put it back to the bank, back to the business normal BAU, right? And maybe we would have gotten a better return. So I think that strategic element is important, and I can give a probably example that we've widely quoted. One of the companies that we've worked with, almost co-created the company with and invested, is Silent 8. So Silent 8, we were their first user, one of the first corporate investor, and after us came HSBC as a user, as an investor, and now they've gone on to work with many other banks. And I think I like to think that we give other banks, other users that sign off, right? That vote of confidence that we've done our homework, we've almost co-created it, we went through all our processes to say that yes, you definitely we can use you, and it's in the RegTech space. So we've gone through all our compliance needs, and yes, we can take you further. So I think that really adding value for CVC, strategic value is important. And as a bank VC, everybody is a lot of the players are bankers, and the only thing you know about bankers is MDs move around in cycles, right? So whatever connections you require, our bank has 1,300 MDs. I guarantee you all of them have been across every single bank that you need. Whether it's a niche bank in Iceland or something, we would have that connection. And it's, in the B2B business, it's a lot easier to reach out through a warm end intro than cold calling, right? So I think that's the strategic value that we bring. And last bit before I oversell is really, I think we are a user, right? I think that's an important bit. As a user, not only do we give revenue, but we also guide you through the process, right? What's good, especially if you're early stage, your Series A, Series B, say, hey, this is good, interesting, but hey, maybe there's 3 things that if you want to sell to a global bank, this is what you need to improve on, and this is what you need to help, or even this is what you need to pass a procurement process. Because when you sell to enterprise, it's very different from selling your mid-level banks or even other FIs. And downside, I wouldn't say anything, but I'll say in the other panel session that we had that was similar was speed, right? Unfortunately, banks or corporate CVCs do follow a process. As much as we try to be separate from it, there is still a process that we go through. And I think if you have a term sheet from a bank VC, you'll see a lot of new clauses like a bank holding act, and a lot of new clauses that you've never seen before, you've never taken bank VC money, but there is definitely more process, and we would never be able to move as fast as, let's say, Vertex, right, in any deal, but although we move quite fast too. And Puiyan?
Maybe I'll build a bit upon the lens on CVC, and then I will talk about pure play VCs, right? So I agree with all the points that Alex talked about. I think the major difference here is the way that CVC underwrite a deal is typically different from how pure play VC underwrite a deal. And I encourage all startup and founder to understand that process so that you go in with the eyes open, right? So for any corporate, and maybe to take a step back, you have to understand their reason for existence. To Alex's point, I mean, the bank's balance sheet is so strong. Even if I make a $100 million return from investment, it's like not even a rounding error for their quarterly reporting, right? The CFO will go, okay, well done, but like I can't. It's meaningful, but it's maybe not in the larger scheme of things. So the reason to exist for CVC is a very important thing to understand for anyone raising money from a founder. Is it because of certain capability that they want to bring in-house? Is it because of branding, halo effect? It could be many reasons, and I think to figure it out earlier rather than later is important. right? And I agree with the point about navigation and timeline. So again, there's a spectrum of corporate investors in the market. There are those that will require a business sponsor to sign up to certain revenue targets before the VC arm can make an investment. So someone's life is on the line, right? They have to sign up to a target before that deal can go through. And you can imagine if anyone is put on a KPI, it's never an easy conversation, right? But there are those that only require some indication of a potential strategic relevance. And that's okay because it's for the deal team to paint the picture. But regardless, right, there is some layer of strategic relevant sheen that you kind of need to get past. And the last point about the underwriting is that, to your point about long haul, if you are strategically aligned to a corporate, they can be there for you, even for many years, as long as you kind of fulfill that gap. But you kind of need to figure out the navigation piece, right? MDs rotate around every 3 to 5 years, especially those who are performing well. They would go on to do better things, and you have to make sure that the next guy who take that seat to be your key sponsors understand your values and understand your vision. So then I'll now shift gear to pure play VC. I think I do not disagree with what all of you have said. Decision making can be fast, right? So I have seen deals done within Vertex, within a month, but I've also seen deals that take months to cook, right? It really depends on the nature of the deal, the sector, the co-investor, syndicate, etc. But I think the difference is that there's clarity in the way we underwrite, because it's about whether we think we can value add and make the returns, right? So VCs will also tell you all sorts of stories about how they can value add, and I would encourage all of you to do your own homework, right? Like for example, for a firm like Vertex, we've been around since the late 80s. The team has a lot of institutional memory or wisdom, good or bad, and we have seen through the ups and downs of .com and whatnot. There's a lot of battle scars. We have worked with great founders through good times and bad, and there is a community that we're also trying to build so that there's peer learning, right? So having, I guess maybe the final point to sell and to pitch myself, having a platform, a brand on your cap table that's strong branding it will also lend to your credibility, right? But there are all sorts of VCs also generalizing here. Yeah, I'm gonna pause here, pass to Nick.
Yeah, maybe Nick, can you weigh in here? Are they, how have they pitched? Are you convinced? What would you choose? But maybe for Validus, I know you've taken a little bit more from CVC, but maybe also as a second question, if you were to start a new company again, does it depend on what your company does, who the customers are? Would you then pitch accordingly to CVC or VC, or does it stay the same? Maybe you can answer that for both Validus and if you were to start a new company.
Yeah, I think this is a tough one. Maybe, just if we think about, the movie Willy Wonka and the Chocolate Factory, right? For those of you who've seen, there were lots of chocolate bars, and some bars had a golden ticket. So my personal advice would be, if you're taking money from a CVC, the value add is the golden ticket, right? The money is the chocolate. So, we know we're getting the chocolate. We may or may not get the golden ticket, right? And I do agree with Alex that a CVC has the power, which the VC does not, to change your life, right? They give that one deal, they give that validation, they become your largest customer. It can, take a startup into stratosphere. But realistically, that happens much less than what we would expect it to be. So, to answer Liz, your question, would I take money from CVC? It all comes down to, what choices do we have? If that's the only check on the table, I'll take money from Vladimir Putin, right? Right. But if you have, I mean, that's the founder speak, right? I mean, when you need money, we'll take anybody's money, right? But if there are multiple checks on the table, then I think it's time to ask some fundamental questions, which is, yes, what is the nature of the CVC? Is it a bank? Is it a conglomerate? Is it a prominent family? And why do I come down to that? Is because for me, there is nothing called a bank. It's a mythical creature. There are only departments and people within it who have the power to change, the fate of my company and my fate. And therefore, what access do I have to them? When it comes to a large family-owned conglomerate, I know that there is, a big granddaddy or a big grandmommy on top who makes decisions, and I can call them up at night, right? For example, when we went to Thailand, there was no license to do digital lending. Our partner, CM Cement Group, they took us to the regulator. We sat down and created a license, and magically we became the first company to get that license, right? So that is the power of CVC. But at the same time, again, coming back to the example that Alex gave, that MDs rotate, and often they are not part of the investment team. So it's important to figure out that the people who are going to add that value, do we have access to them, and how bought into the process they are. So what we've learned over the years is when somebody comes and says that we'll do ABC things, we tell them put it down in writing, right? So maybe we'll give you X amount of stake today, and I promise to give you some more as long as you meet these KPIs for me. And if you don't, then too bad, we won't give it to you. And that has worked out really well for us.
Anything to add on as a final point to that?
I love that you're giving your investors KPI. I love it.
Okay, maybe to put it into context, so it's been a while. So how long has it been since COVID? Quite a long time. Then we went through a short market crash. Then we went to almost a 2-year bull run, and then now the market seems like it's going back into correction. And we're all waiting for this kind of like recession that's coming, but we just don't know when. So with that, doom and gloom backdrop, like what has been, and is there any challenge to, let's just say for VC and CVC, like in terms of your investment mandate, are you looking at companies maybe earlier, in the phase of the business cycle, or, has anything changed with regards to the way that you look at investing into early stage companies?
The mic, so I'll start. I think, when we started COVID, for some reason, both startups and investors, they all went out and go, okay, this is the moment that validates that everything will go digital, and there's no sort of, there's no physical and human element involved anymore. And so we went through this period euphoria. I think now with COVID behind us, we realized that we are, we want to, that is true, but it's only true to a certain extent, right? And a lot of companies have gone on to raise a lot of money and become very undisciplined, and they burn through the roof. What does it mean for us? Actually, there are two sides to the coin. On one hand, we have a lot of active portfolio under our management. A lot of them are also going through that journey to realize that we have now to take a different approach in managing our cash reserve. Companies that are doing well and have a lot of cash reserve, they may go, okay, I may just hang on a little bit and wait for the market to correct, and before I decide what to do next, right? So they may or may not choose to raise fund at this moment. There are those companies that are struggling. They are unfortunate. They haven't proved product market fit. They are they have burned too much, or they just couldn't raise. Of course, we as investors have to figure out what is the next best course of action for them, and we work with them through it. There's those in the middle, and they go, okay, they kind of have the runway, and they, but that runway will end soon enough if they haven't figured out what to do. So we have been quite caught up this year to work with all our portfolio companies to figure out what's the next best course of action for them. So what does it mean for us is, as we look for new deals, it's the same. So we are now also, we are still very actively looking for new deals because we just pluck. We just announced our new fund. So we are very active in the market to look for good opportunities. But we are also now more discerning, right? So as I mentioned, some of our better performing companies who have cash runway and who are doing well, they may choose to pay. So those opportunities come to us, we are more discerning to figure out where really the risk element could be. We are also therefore working harder to look for good opportunities that may not be thinking about raising yet and go, hey, you should take the money now because we can help you for the next leap, right? But overall, I think there's a bit more, discipline and in the market. It's good or bad. I think we don't want to be overly cautious. We hope to be still consistent with the pace of investment. Yeah.
I think for corporate VC point of view, no difference. I think we are still looking at whatever the VCs are looking at in terms of strategic. I think you probably think of things, about financial, probably talk about things like people looking at better unit economics, positive EBITDA at hopefully B, C, and or clear pathway to that, right? I think nothing's different. We also announced a 100 million digital assets fund to be launched in Dubai. So we are also looking at the same lens that Vertex is looking at. New deals, how do we look tougher? But maybe what's different for us, I think, again, from the CVC point of view, what I'll be stressed about if the market is going to a recession is, hey, is my business unit, whoever is the sponsor or the champion, are they still using this company? Is my company's contract, my portfolio contract at risk? And what can I do about it, right? Can I pre-warn it, or can I do anything, step in to try to help? Or can I go and look at other friends in other banks to say that what's happening? Is there something that's at risk? Do I know like certain banks or certain departments that have an issue with budgeting, and really hopefully give a warning to the portfolio companies saying that, hey, watch out, right? Your key marquee customers, 5 of them, from what I heard, I don't think they're going to be your marquee customers anymore. I think that's what I'm worried about, and that's how we try to help. I think from the investment point of view, exactly the same thing, right? We both need to make financial returns, and I think it's a tough call to say that a strategic investor will go into a bad deal for the sake of it. Yeah.
We haven't talked about valuation. So what are your thoughts, and has that changed? How are you looking at valuing companies?
I think exactly the same how market multiples, right? Whatever the public markets comps have dropped, will be exactly the same. Maybe to talk on Nikhilesh's point, warrants, right? The warrants that we might ask for might change, right? And I guess from the portfolio company's point of view, if we had asked for warrants, maybe we said give us a $1 million contract and you give us X million number of shares. Maybe now the renegotiation starts. We don't think it's going to be $1 million. Maybe we're asking for $500,000 now for the same amount of shares, right? Simply because times are bad, and although we are a big bank and other big corporates too, money is tight everywhere, right? Maybe that might be the only thing that changes. I'm sure in terms of valuations, we are very similar to how Vertex will look at valuations.
I think so. I joined Vertex about 4 years ago, and I was joking with Nick earlier that he has been with Vertex longer than I have been. So I think one of the one of the things that Vertex is being known for, I suppose, is that we are very disciplined, quote unquote, with our investment piece and what we offer. I think during the period where everything was going haywire, systematically, we also had to pay up a little bit to get into certain deals, but overall our investment pace has been very consistent. I think the difference now is that we actually can have a proper conversation with founders. I mean, it's funny. I mean, during the haywire days, I would have a lunch with a founder, and the founder would tell me, I'm sorry, but you have to let me know by Thursday, like 2 p.m., and the lunch could be on Tuesday, whether you're in or not, because I have like 5 term sheets waiting for me, and we would have to politely decline because we seldom buy to those foremost. But now we can actually do proper duty, and it's not like we're taking our time, we're just doing the work that we are paid to do by our investors, right? So I think I would say that I feel like the pace is what is not a bad one, but I also, actually internally within the team, we tell ourselves not to be overly cynical about opportunity because we are still looking out for good opportunity. So, yeah.
Nick, do you have any funny stories? Have you created any FOMO amongst the investors you've spoken to?
I think before that, when Puiyan says discipline, what she really means is cheap. Yeah. No, but then that comes down to the point, right? So, in spite of being in the founder seat, I'm quite happy with the fact that a lot of froth has gone out of the market. Maybe because when we look at ourselves, we never participated in that crazy market, and as much of jealous I might be, maybe it's a good thing. And that is because till a few years ago, when I would start a pitch, I would start by saying that, look, the words you will not hear today are Bitcoin, crypto, blockchain, disruption. So, if that's your thing, then we're not the startup for you. We were a boring SME lending startup, which for a lot of people was just not happening enough. And as luck turns out, a lot of those investors were tourist investors. These were marquee names from the US, Europe, who came, sprinkled around a lot of money at mind-boggling valuations. But what they ended up doing was crowd out really long-term investors. So when we started our CVC fundraise early last year, January 2022, that is when the market was slowly turning. So when we went to speak to these fly-by-night investors who would write a check within 24 hours, we found that we were not hot enough for them. And then we went to more long-term investors. We found that they were just not ready to come in at valuations that were being thrown around. And we lived through that experience because we saw the 12 months when the market went from being absolutely crazy to absolutely dry. And we actually closed our C1 round in December last year, which was probably the bottom of the market. But we managed to bring in Japanese and Korean financial services firms and banks. So as the valuations got more realistic, we saw a lot of Japanese, Korean, Taiwanese financial services firms, banks come in, write checks, and we know that they are going to be here for the long haul. So as much as it hurts that there is not a unicorn being created every hour, maybe what is happening now is a lot more realistic and better for the firm.
Thanks. So we haven't really spoken about regional versus international type of investors. And you mentioned Korea and Japan, and we had a conversation earlier that you have also investors in Europe. But I think so. What has been your experience, negotiating with, or even just pitching to, regional or international players? Let's say.
There's pros and cons, right? I mean, with a lot of the non-regional, non-Southeast Asian investors, it's far easy to spin a story, as we would have seen. I mean, you can give them any story on Southeast Asia and demographics, and it used to fly. Not so much now. But when we look at the two sets of investors, we again ask ourselves, what is it that we are trying to get out of them beyond just money? So, just speaking about our industry, when I look at lending, whether consumer lending, SME lending in Southeast Asia, IPOs are still a mirage. There have just been a handful of IPOs for tech companies in Southeast Asia, and I really don't know when that market is ever going to come back. Which means if you realistically need an exit, majority, minority for your investors, it's going to be a financial services firm who's going to give that exit. If I look at Southeast Asia in the last 5 years and draw up all the M&A that has happened, there is not a single M&A done by a Southeast Asian bank, right? And I can just say it loud, the DBSs, OCBCs, for all the big talk, have done zilch. If you draw up every single M&A in Southeast Asia, 100% is done by Japanese, Korean, and Taiwanese firms in that order. And therefore we said, these are the names we need to get on our cap table. Because, you get them, there is a circle of trust, and that's how we'll eventually get to investors who are really, really going to take us somewhere. But that was again very, very bespoke to us, because that is what we said, that is the future. The second was the experience that for a lot of East Asian firms, something again that Alex mentions is that the cycle for an investment or an M&A is extremely long. And I'm not talking 12 months, I'm talking 36 to 48 months. So we were like, we start the process now, start roping in the big names, or you get in basically the tier 2s, we'll introduce you to the tier 1s. So 5 years from now, we'll be in the best place or position to do something. So that's the perspective that we took.
Thank you. And let's move back over to the investor side. So Vertex being one of Southeast Asia's oldest VC, you have expanded beyond the region to China, to the US, to Israel. I think it was Israel. Maybe could you share your thoughts on, the way that you look at investing when you were just a regional player versus now where you have basically an international presence?
Yeah, so maybe I can take a step back and clarify the structure of Vertex, and actually it's a bit different from other global funds. Vertex is like a federated model. So each fund actually operate rather semi-independently, but collectively we are Vertex Ventures. So for example, I'm part of Vertex Ventures Southeast Asia and India, so my team and the LP actually invest into the Southeast Asia and India story and mandate, to your point. And then we have a fund in Israel managed by the GPs there, and they have their own investment mandate and process and thesis, and I think we have now also US and everywhere. So I think that the interesting pro maybe of this approach is that we actually have really local teams scouting for local deals everywhere. And I think having operated in a global fund, my prior fund, Singtel Innovate, was a global kitty, so one kitty for all investment, and the mandate can be anywhere. So during my time there, I had done an Australia deal, I had done a China deal, also I have done a Switzerland deal, right? So, and there's really pros and cons for both, but I think for the federated model that I'm currently part of now, the strength is that the investment team have local networks, they have local understanding, and so sometimes it's about pattern recognition. So even if it's a new company with a new business model, we can understand the potential pitfall, the strengths and weaknesses of a new opportunity just because we are so familiar with the region. Now, it's not to say that local funds will not have global networks. So if if you can always do like a 1 degree up, the investor base, the LP pool of your fund is also an important factor because many LPs look for co-investment opportunities with the firm they invest into. So we have also global investor base. Different firms will have different sort of profile LP, and you should absolutely take advantage of that. Yeah, but I think the pro of operating from a global fund, for example, a Singtel Innovate, would be that there's no limitation, right? So if an interesting opportunity come along from Europe and they want to pitch to me, in reality, unless they flip to Singapore or unless they have a very strong market orientation, it would be not really technically within my mandate, but there was no such limitation when I operated in Innovate.
Thank you. So Standard Chartered Bank, we have a significant presence in Asia, in Africa, Middle East, but maybe specifically about the SC Ventures. Alex, can you elaborate on that and also how we look at investment?
Yeah, I think for us, it's a global mandate. From day one, all the funds all have a global mandate because we're an international bank, right? I think we do not have a specific geography that we are especially focused on. I'll give you an example. Even though most of the team is here based in Singapore, most of our investments are actually outside Asia, even outside Southeast Asia, outside Asia, right? What's great for us is I think we have an international outlook. I can give you an example, right? During COVID-19, I like to say early 2022, back here in Singapore, small outbreaks, 1 to 5 a day, right? When we're talking to our IC, which was an international IC, everybody, depending on where you were, had a very different outlook. We have folks in Europe, which basically say, why are you guys pitching this deal? The world is going to end. No, I object to any deals, right? And then there were folks in the UK, well, things look pretty much okay. And back here in Singapore, we're like, why is everybody so paranoid? In Southeast Asia, there was nothing, right? So I think we get a global outlook of how everything moves. And I guess looking at all the different deals, we also have a global outlook of how deals are being priced. I think over the years, Southeast Asia has always been a laggard, or maybe there was too much money here. We joke that valuations in Indonesia were even more expensive than in San Francisco, and we could see how the different multiples work around the world, and to get almost a future, right? To say that this is how a company in this space in a mature market worked. This is likely how it's going to be, and we know the people there, and we just have hopefully a global view about it, and with the connections that we have. Hope that sort of answers the question. I skirt around it a little bit.
No, that's really good. So let's throw in some buzzwords here in some bonus questions. So AI, you know, everyone's talking about that. There's always, you know, an element of that whenever we talk to startups. So how has AI kind of changed the way that you look at investing? Like very broad, general question.
Maybe I'll take a step. So for some of our portfolio companies, we actually asked how would AI disrupt how you work, especially enterprise-facing companies. A few of them have actually added on sort of AI chat GPT wrapper or LLM wrapper to you know, apply the large language models on their businesses. But we, you know, generally we are concerned that it may disrupt some of our portfolio's business model, but we're also optimistic that it can create new opportunity, right? I think one thing that we like to also from a not really ESG, but from a data security perspective is also something that we look at. The last thing we want is for our portfolio companies to lose competitive advantage because all the data is sort of out there floating somewhere, being accessible. So, you know, but in terms of new deal sourcing, we are seeing actually more companies trying to take advantage of the space, whether it is, okay, in reality, I don't think we will, from my perspective, because my mandate is Southeast Asia and India, I don't think we'll find the next sort of OpenAI type opportunity here, right? They have raised billions and billions of dollars. It's just, maybe it's possible, but maybe that's not, you know, it won't come to top of mind. But there are many startups doing wrapper stuff. There are those that are doing, you know, the tooling that will support the AI industry, so whether it's data tagging, whether it's annotation or sort of fine tuning. We're looking out for those opportunities, yeah.
Want to take a stab?
I think it's only be useful for us because we have invested in a couple of, at that point of time, already called explainable AI companies, but it wasn't a word there. So I think what has come around is the companies telling enterprises, this is actually what we do. And here's the video to look at it, right? Other people are explaining it, so it's been good. I think enterprises or their customers have been embracing that. And I think from an investment point of view, I think it's helpful, right? So our analysts can hopefully get a lot more info a lot quicker, right? I think comms list is probably the hardest thing to do right now. You can go ChatGPT, you get 80% of it done. So I think work has hopefully been faster.
Do you think eventually our investment memos are going to be written on ChatGPT or something private?
Why not, right? But I guess that's still that IC interaction that they go to. Unless the IC also becomes AI, then things have changed.
And how about you, Nick? Do you have any sort of AI LLM wrapper that you have in Validus, or is this totally not within your realm? Yeah.
AI, no. I mean, we've used machine learning to develop algos of our own. I'm personally not a big fan of AI. I mean, yes, we've gone through just past a tipping point. Some graphic designers will lose their jobs. Some people who are just kind of just Googling at work will maybe made redundant. But just the point that you mentioned, right? That if you put in all the information, does an analyst lose their job? Well, technically, right now what AI is doing is just regurgitating everything that is already there in the internet, which means anybody who was truly doing something original, something different, I don't think they have much to fear. Secondly, again, just sitting where we are in Southeast Asia, half my customers don't have a bank account, people don't have any documents. What AI? So I think, yeah, I mean, it's going to change the world, but yeah, I don't know if I'm going to be alive then.
Okay, thanks. So that's all the questions we have for the panelists today, but I'll open up to the floor if there's any questions. We'll take a few, if there's any. All right, I think everyone's ready to go for drinks. All right, well, why don't we just thank the panelists for today, and also thank you all for coming to today's session.